AI has a much more limited applicability than people think, but it's very powerful in that it can do things the rest of us cannot do because it's so good at repetitious tasks and finding things that have already been done and cloning it and doing something similar. That's why it's so good at coding. But does it have identifiable products? No, I don't think it's gonna replace labor. I don't think AI is gonna do that. I think AI creates more opportunities.
Welcome to The Rubber Meets the Road Economics, the podcast where we explore the driving forces behind today's economy and their real-world implications. Join investor Hunter Craig as he interviews Professor Edwin Burton from the University of Virginia, delving into the complexities of economics with clarity and insight. Whether you're an economics enthusiast or just curious about how economic policies affect your daily life, you're in the right place. Let's get started.
Today is February 11th, 2026. We're here today. World-renowned Professor Edwin T. Burton from the University of Virginia. Professor, the yield on the U.S. 2-month Treasury is 3.69%. Yield today on the U.S. 10-year Treasury, 4.17%. You correctly predicted the Fed would not raise rates on January 28th last month. Fed meets again in March. Professor, the Dow recently hit a record high of over 50,000. Are we in an AI bubble?
We're certainly in a lot of mini bubbles. You saw that in the software industry this past week. The minute the Claude Code was announced and the Kodak 5.3 was announced, the software stocks got whacked. They dropped 15 to 20%, and the broad market lost an enormous amount of ground. But it made it all up by Friday, so the crash aspects were limited to folks who provide software to businesses. And the significance of all that, as everyone knows, is that you can use a lot of these chat models, and there are currently over 40 free chat models out there. They'll cost more than being free, I'm sure, at some point, but they won't cost as much as hiring Palantir to come in and do all the stuff that you need. And that will affect Palantir and companies like that. And that's what happened this week. They got whacked, and they haven't fully recovered. When the market recovered, the software companies didn't come back as much. But you're having sweeping sort of crashes as you go through the market. Stocks that rallied the most are finding a tough time, but the broad market is still in record territory, basically. It's either right at its record or very close to it. So the stock market has been super strong, and nothing seems to deter it. Some of the background news got a little bit weak, but this morning, for example, we had a very strong employment number, at least relative to consensus. It came in at 130,000 jobs for the month of January, and that was a lot bigger number than anybody was expecting. So the economy, it's obvious that the economy is still chugging along. A lot of that is probably related to the capital spending and artificial intelligence, especially the spending on data centers, the spending on microprocessors and various chips. All of that is driving capital spending, which is really high. And you see it every time there's an earnings report from one of these companies like Meta or somebody. Their capital spending is chasing their earnings. And if that spending is actually expense, there are no earnings. Because for Meta, the capital spending actually outran their earnings in one quarter last year. And that's beginning to be a problem for everybody. Everybody's announcing these large capital spending programs, and they're treated on the balance sheet like capital, so they're not expensed immediately. But even if you don't expense them immediately, you'll have to start expensing them as depreciation. And this is not 20-year life properties. This is property that probably has a 5 or 10-year life at best. So I would have to say, given that most of these companies haven't identified where the new revenue is going to come from, Meta, Google, Apple, everybody, it seems like a bubble, because normally when people spend a lot of money to build, the plant and equipment, they have something identifiable that they're planning to make. In the AI world, it's not clear what they want to make. And they look back to the internet bubble and they say, well, maybe that was a bubble, but look how many companies came out of it. Amazon and Uber and a host of companies who took advantage of internet capability and built huge businesses, which are still with us and have done well. And of course, Microsoft as well, those who helped provide the background for that. And so people say, all right, yes, there are going to be a lot of companies fail in here, but I think it might be more than that. Given the level of the capital spending, unless there's some identifiable products here, and to be honest, I'm dubious that there are that many, because what AI is really a way of pattern matching all the libraries in the world and searching and scraping, they call it, the internet, for a ton of data, and that's not perfect. There are so many fields where the data is not very good. Gosh, in my own field, if you scraped all the economics textbooks in the world and scraped everything said on the internet, you might get misled. A lot of that stuff's really not very good research, to be honest. So it's not clear that an AI agent going out and roaming through all the economic publications of the last 150 years would be the person you'd want to call on to predict something. For example, when inflation took off after early 2020, there was only one economist over the next 2 years that predicted there'd be any inflation. That was me. The rest of them didn't. There were people like Larry Summers who, as late as 2021, said there might be a threat. Well, saying there might be a threat is not the same as making a prediction. And so if you scrape the whole world for all the economics information and you had all the information at your fingertips, you might not know anything. That's the problem. You only know what's in the world database of all that. And a lot of it's incorrect. A lot of it's not factual. Imagine doing this in medicine. Suppose you wanted to diagnose a patient by using what you could scrape from all the medical records. Well, a lot of them, the diagnoses didn't fit the patient very well, and yet that's the information you have. And so if the AI is only as good as the information it's trained on. And some people pick this up by noticing the biases in AI. For example, most AI chat users are men, and these AIs are trained to be friendly to whoever's talking to them, so they tend to be pretty friendly to men. Parmy Olson, who writes for Bloomberg, noticed that in her book called Supremacy, which is a very good book, by the way. Supremacy, it came out last year. And it's a history of development of AI. So if you've used it, you know all the things I'm saying. You know it makes lots of mistakes, and it's only as good as what it's trained on. But let me tell you where it's really good. It's good at doing things that are repetitious, pretty well defined, and that's why it's so good in coding. If you wanna write a program, oh my goodness, it can write a program that used to take 3 years to write, and it can do it in 2 hours and do it right. Do it probably better than you could do it in 3 years. So it's very good at coding because that's just a logical process. That's not as dependent. All you're searching are the existing code, and that code wouldn't be there if it wasn't working. So you're looking at stuff that you've kind of already pre-tested. And if you're, let's say, doing your taxes or doing accounting work or something like that, where all the rules are well defined, it's going to make real headway there. One industry I think is really going to struggle with this is management consulting. My experience in the corporate world is you brought in a management consultant and you would tell them, here's what we're thinking about, come back and give me a report. Well, you can ask AI to do that now, and it'll come back in 5 minutes with a report probably better than you could get if you went to McKinsey or Bain or somebody else. And maybe I'm wrong about that, I don't know, but I'll bet you Bain and McKinsey and BCG are thinking about that right now. They have to. Anybody that's in the business of giving advice or poring over data and coming up with a conclusion has got to be a little bit nervous, because these artificial intelligence agents might be better. If you can rely on the information, if it's reliable information, they can probably put it together better than anybody else, certainly better than a human being. But those are limited things. When Sam Altman talks, he talks about, we're going to solve world hunger, Sam. I don't think so. I don't think that's where this is going. Unless somebody's already solved it and didn't tell us. AI found it somewhere on the internet. If you can't find it on the internet in a book somewhere, AI is probably not aware of it. that Altman would kind of disagree. He has a mystical view about what AI can do, but the truth is it's a big pattern matching thing that just searches the globe of books and literature and newspapers and the internet, and if whatever's there, it assumes it's true, unless it can find countervailing evidence against it. It has to kind of grade everything and come up with its best guess. But if we all have the wrong consensus, if we all believe something that's not true, then the odds are AI is going to believe it too, because they're just combing our thoughts when they read all this. So two thoughts emerge from this. One, AI has a much more limited applicability than people think, but it's very powerful in that arena. It can do things the rest of us cannot do because it's so good at repetitious tasks and finding things that have already been done and doing something, kind of cloning it and doing something similar. That's why it's so good at coding. But does it have identifiable products? No, I don't think it's going to replace labor, workers. They're more likely to be replaced for other reasons. I don't think AI is going to do that. I think AI creates more opportunities. It's going to create more businesses that now needed that data processing to be businesses. There'll be businesses that if you can process data very cheaply and come up with conclusions very quickly, you now have a business you couldn't have had before. And if you think about it a minute, how did Uber come along? Uber didn't invent the internet. But once you had the internet and you had Wi-Fi and all that stuff, all of a sudden you could communicate for free. The guy could hop off a plane, communicate immediately to a driver of a shared vehicle, and get right there. And in fact, you don't even have to take your wallet along. You just have to have your iPhone. You just pay for the whole ride on the iPhone. But the Uber took advantage of an existing technology. When communication is free and you can do all that, then you can create the guy with the ideas, he comes up with it. The same thing's going to be true here. If you can sit there and say, well, before I could never have this company because it costs so much to get all this data together, but now I can. Insurance, for example, might be an area that could benefit because now all of a sudden an insurance company can mine a lot of data. They can go out and find a lot of data, and maybe they can figure out what their insurance rates ought to be based on what they see. That's not easy coming up with all that data, but it might be a lot easier if you have an AI agent to do that. But I don't know, I'm not going to be the one that builds the company, but I think that's what you'll see. You'll see new companies that do new things. Those companies are going to hire plenty of people. They're going to provide a lot of services for people. But will the people that are at the top of the pile now still be there in 5 years? I'd be willing to bet no. One of the things that happens is you look at NVIDIA. Everybody looks at NVIDIA and says, they're unstoppable. You can't stop NVIDIA. Well, the one thing that's going to stop NVIDIA is knowing they make so much money. When you go out and announce to the world that you're making a lot of money, guess what? People hear that and they say, oh, really? What do they do? Oh, maybe I can do something similar. They're going to have so many competitors in the space of building chips that within 5 years, they'll probably be lucky to hang on. That's why monopolies sort of disappear pretty quickly, regardless of whether there are any regulators or not. Because when somebody makes money, people notice that. That's the most noticeable thing in the world. And people want to be like that. And they want that money for themselves. So they come in and build a competitive product. And we're in a global world now. That may not happen in the U.S., may happen in China, may happen in India, may happen in Vietnam, could happen anywhere. So I wouldn't bet on all the horses that are leading the race at the moment. Some of them may survive, but a lot of them won't.
Professor, the U.S. dollar had its worst performance in 2025 in 8 years. Ken Rogoff, Harvard economist, professor, wrote a book recently, last year in 2025, Our Dollar, Your Problem. What effect does the falling dollar have on, 1, equities, and 2, interest rates?
Under any kind of reasonable circumstances, currency movements shouldn't matter, but it turns out in the real world they really do. When you look at single currency areas like the U.S., why isn't there a balance of payments problem between Texas and Oklahoma? I mean, they're trading with each other all day. If they decided to have separate currencies, would that create a big problem all of a sudden? Currencies should just freely fluctuate out there. And they really shouldn't matter, but it turns out they do matter. And a lot of that is that people worry about what they are. And every time the dollar goes up, people talk about it. When the dollar goes down, as it has for the last year or so, it's down about 12% off its high now. When that happens, people start talking about it. So what's the effect of the dollar falling? Well, if the dollar's lower, what does that mean? That means prices of foreign goods are higher, and we're going to want to buy what they have. And if the dollar is higher, then we get pretty expensive, and that's going to cut into our ability to export. And you're seeing a lot of that in the data. Does the U.S. want a higher dollar or a lower dollar? Well, the president has come out for both. He has said that lower dollar doesn't bother him, and he said he really wants a higher dollar, and he kind of alternates saying those things. Well, he used to be a spokesman for a higher dollar, but now he's beginning to make noises. I think he listens at the foot of the president every day for which side of the fence he ought to be on. That seems to be a popular thing to do if you work for the president. You wait to hear where he's going, and since he changes his mind almost daily, it's sometimes hard to keep up. But overall, the dollar is not significant unless somebody tries to move it somewhere it shouldn't be. We should just let the dollar float, really. We shouldn't even care where it goes. I know that's heresy in the minds of all the political people, but that's what I think. But once we start trying to influence it and say, well, we want a stronger dollar, so let's do something to get it. There's a popular view that high interest rates create a stronger dollar. You'll hear that all the time. Well, U.S. rates are up, that's why the dollar's up. Not really. That's kind of a money illusion. It's based on the famous carry trade where you borrow in Japan at 0 and invest in the U.S. at 5 and all that sort of thing. Broadly speaking, history tells us that currencies that are permitted to freely fluctuate probably aren't very relevant. It's when people try to pin them or peg them to gold or peg them to another currency. The Asian countries got in trouble back in the 90s because they were all pegged to the dollar. And then and they sold debt denominated in the dollar. They sold sovereign debt denominated in the dollar. And then when the dollar went up and their currencies went down, they were in big trouble. Couldn't get their hands on dollars to pay their debts. And that's why you had the 97, 98 crashes in Asia back then. So I would say, like a lot of things in economics, if governments would take a longer vacation and not worry about where the dollar is, we'd probably all be better off.
Professor, rumors in economic circles are that you have an AI-generated model that does predict short-term interest rates.
If you're within a couple of days of an FOMC meeting, it's very easy to predict what they're going to do. And that, I can't remember, I don't think I've ever failed to predict it accurately in the last 20 years. I've certainly predicted it here a number of times and never been wrong. But when you're within a couple of days, all you do is look at the T-bill market, and that's going to tell you what they do. They're going to put the range where it encircles the current T-bill market. The question is more interesting. What if they want to lower the rate or raise the rate? Do they do things in advance of those 2 days? In other words, do they start doing things in the open market operations or through their repo and reverse repo facilities that move the rate that way? And I've just started looking at that. I'm an amateur coder. When Claude Code came out this week, I jumped all over it and immediately started writing. And it can write a program in 30 minutes that just would curl your hair. So I asked it to search out the 15 days prior to the last 120 Fed Open Market Committee target dates, and it did. Searched out all the data on what was happening in the reverse repo and repo markets and the size and the rates and everything prior to the Fed making a decision, and it separated the three possibilities. If they raised the rates, what was the pattern? If they lowered the rate, what was the pattern? And if they left it alone, what was the pattern? And sure enough, the pattern I expected was right there. Now, that strongly suggests that you can predict what the Fed's going to do by studying that pattern. Now, it's not definitive yet because there's still some work to do, but the work that Claude Code did for me would have taken me a couple of years and 3 or 4 researchers to do. And it did it in an hour. It's unbelievable. So I decided to ask it, well, what's going on today in all this? What's happening in the repo market? And reverse repo market, the facilities that the Fed provides, not just the repo market, but what's known as the Fed repo facility and Fed reverse repo facility. And so it went right in and got the data online this afternoon. It was amazing. And this is all done with Claude Code, which just came out last week. What Claude Code does, and you need to be a reasonable programmer, in my opinion, to use it, but if you explain the Claude Code what you want to do and how to lay it out and where the data might be and what you want it to look like when it produces the output, it's unbelievable what it can do. Now, you have to go through several iterations. When I first got it, it had every single rate change being unchanged. And I said, whoa, there's a problem here. We had some rate increases and some went down, and so they revised the program. But it even color codes the differences between the reverse repo market and the repo market. It's really amazing. It does a lot of things on its own if you write down enough information in the prompt to lead it in the right direction. And that's why coding experience helps, because you kind of know what computer programs are supposed to look like and how they should be structured. And I've written a lot of computer programs as a hobby. So these things are unbelievable for me. They're very helpful. But I labor on this to show that it makes people a lot more productive. There are a lot of things I wouldn't even think about looking at. For example, looking at all the data before the Fed meets and looking at the preceding 3 weeks of data. I wouldn't think of looking at that because it would take so long to assemble it. And at my age, I could spend the next 10 years putting the data together. Claude Code can do it in an hour or less. That's remarkable. So that's why I think it'll make people productive. So there are going to be companies that couldn't exist unless it can do something kind of like that. The genius is going to be the person who looks at this stuff and says, okay, I see what it can do. It can go find data, it can massage data, it can present it in a reasonable way. Here's a business where that really matters. And that person's going to be the next Uber or Amazon or whatever it is, and they'll make a huge amount of money. I don't think these LLM companies, Anthropic, OpenAI, all the ones working on this, there's so many of them. They're all competing. They're spending a fortune. I don't think there's a big enough pie, and they're not all going to win. OpenAI, notice the problems OpenAI has. Poor Sam Altman. He's a great salesman. You got to hand it to him. He's raised money from everybody from Elon Musk to Microsoft, Google, whoever's out there. He manages to get money out of them. But the one thing he doesn't get is any revenue in his business. It's almost no revenue from ChatGPT. He says 10 billion. That's revenue. He wants $1 trillion valuation for his company. Look at those numbers. It literally makes no sense. Now, he might get it. I don't know. There's not enough money to go around, though. Elon Musk is, he's merged SpaceXI and XI, which, by the way, was a mistake. He shouldn't have done that. He should have taken SpaceXI and just done an IPO with that. He probably could have got $1 trillion valuation just for that company. And he should have sold XI to somebody else and got out of that business. And interesting enough, XI, all their staffers are quitting after the merger. He wants $1 trillion. Well, there's $1 trillion here, $1 trillion there. After all, how much money is there available for all these IPOs? Well, there isn't. The only thing that seems to be a lot of is the CBO announced today that $3 trillion more is going to be added to the national debt over the next decade. We should be staring at $60 trillion in debt within another 10 or 15 years. There's no stopping that, that's for sure. That roars right on, which, by the way, tells you something about where rates are going to be. If you're asking, well, where are rates going to be down the road, just look at the national debt and look at all the borrowing going on in AI and all that. Supply and demand works. If everybody wants to borrow, including Uncle Sam, you're going to have a big problem getting rates any lower. So those who are looking for 5% mortgages or something like that, it's not going to happen. You've got to get a lot of these debt situations under control, and you're not even close. The national debt situation is worse today than when we started doing these podcasts.
U.S. debt today is $39 trillion, just shy of $39 trillion. Debt per U.S. taxpayer, $355,349. How do we get out of this, Professor?
Well, again, I go right back to the same thing. You've got to tackle the healthcare system. There are other things you can reduce and all that, but it won't matter. The only thing that matters is the healthcare system. The U.S. Just look at the numbers. The family that has an income of $120,000, which means they have 50% higher income than the average family income in America, is paying about $36,000 a year for an Obamacare policy. That same policy before the Affordable Care Act passed was about $2,500, and it provided a lot more insurance. The Obamacare policy doesn't even cover you for a lot of stuff. So now you pay 18 times as much as what it used to be, and you get less coverage. And that's because everybody thinks they're not paying for health care. Everybody thinks that they just go in, get the health care, and then whatever the payments are, they're reimbursed by the government one way or another. I mean, you do not have private insurance in this country. You have a government-run healthcare system because the insurance is all mandated. Insurance companies can't sell the insurance they want to sell you. That's against the law. They have to sell the ones that meet all these various mandates. And the way it is now, people feel like not only they don't pay for their health care, they don't think they should. People think health care should be a right. And if health care is a right, and you should get all the free health care you want, we could easily spend $300 trillion a year on just health care. Wow. We're in a country with 30 trillion GDP. There are limits to what you can do. And the minute you turn something into a free good, people are going to use it. And they're going to overuse it. And that's why, if you ask households in this country now, what is bothering them the most, it's health insurance. That's the single biggest problem most families in America have that don't work for the government or don't work for universities or somebody else who's got a special deal. And you need to privatize the bulk of that.
Professor, thank you. We look forward to hearing more about your model. Well done, Professor.
Thank you, Hunter.
Thank you for joining us for the Rubber Meets the Road Economics podcast. If you enjoyed the discussion, remember to subscribe and stay updated with future episodes. Join us soon for more conversations about modern economics on the Rubber Meets the Road Economics podcast.